From inflation to economic data to earnings, the financial markets are ablaze with information. We'll sift through all of the minutiae to get you a concise view from our experts in the Chief Investment Office right now on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Let's get right to it with Leslie Falconio and David Lefkowitz here in the studio with me. We just got the Fed statement. I'm going to start there with both of you. Leslie, maybe I'll have you kick it off. It would seem to be more of the same. There wasn't anything really new in the statement from the FOMC, kept rates unchanged. The press conference, of course, they kept trying to drill Powell to say if he was going to hike again. He kept saying no. What did you take away from all of that, and how does it affect fixed income in your mind?
Well, I think it's important to start with what the market was pricing in, right? And if we look at how the market has moved just this past, month and a half, they've gone from 150 basis points of cuts to one cut in 2024, 60 basis points in 2025, and only 20 basis points in 2026, right? So not only have they removed a lot of the cuts, but the magnitude of those cuts going forward has been incredibly declined. And also, as you pointed out, there was always this sort of rumor of are they going to hike that was on the table. So the market has had a very bearish reaction to that prior to the Fed, meaning interest rates rose quite a bit during the month of April. So here we are at the Fed meeting, and while, to your point, they asked him at least 5 times whether or not about a hike, and I think he really alleviated that concern. But he did acknowledge that they're not seeing the progress that they would have hoped in inflation over the first quarter, and it's come in much higher than what was anticipated. But he also said that, and he feels this way, that the level of the Fed funds rate is restrictive. So I do think that what they really need to see is more data, and what he did point out, outside the fact that he's seen inflation higher than what he thought, that they are still leaning towards that cut. It's just going to take a longer period of time. But I do think that does leave the market open to potential cuts, whether it's September at the end of the year, possibly earlier. We'll have to see what the data shows. And I think that's really the important part. And also, too, remember, they did taper quantitative tightening, a little less than what we expected, but it's still on the table. And that is somewhat of a dovish acknowledgement as well. So the point being is they're not near their target. They have no problem keeping the level of Fed funds rate at this level for a period of time. Hikes are not impossible, but not probable. And I think he's just going to wait to see the data.
And let's not forget, as we sit here, the three of us, we still have 2 monthly jobs reports from the Labor Department to digest. They haven't come out yet. So before the next Fed meeting. So as you said, Leslie, the Fed will be data dependent. We'll be watching every move of that. And, again, saying that the outlook is uncertain. So, David, with all of that in mind, what did you take away from it?
Yeah, I mean, I think Leslie covered all the important points. I would say from an equity perspective that I think there's a big difference between the Fed delaying cuts, and the Fed actually hiking. Right, so I think that's sort of a different regime. If we really thought that they were likely to start hiking again, I think equities would have a more negative reaction relative to just a delay in the cuts. And as Leslie said, I think the probability of a hike doesn't seem very high. Obviously, we're going to have to see how the inflation data and growth data come in over the next several months. But it does look like inflation will eventually come down, and the Fed will be able to cut, and that should be supportive for equities.
And let's stay here with you, David, because we all have been watching for the last month, especially the month of April has been a little choppy and a little rough for equities. But of course, after a very strong run for many months in a row, which we've talked about quite extensively. But as we sit here, a lot of it has to do with, of course, these inflationary numbers, the data that keeps coming out, wage pressures and, jobs numbers. And, the markets have been a little bit trepidatious. And we're a little bit more than halfway through earnings season at this point. So what do you see happening with equities over the last month? Where are we going now, given everything we know?
Yeah, sure. So you hit on a lot of points here. So I would say, look, we're sort of in the getting to the tail end of earnings season. I would say it's been a good earnings season. Obviously, there's always going to be puts and takes, but in terms of the numbers themselves, we're looking at 7 to 9% earnings growth in the quarter. Companies are beating by a healthy amount. The guidance has been generally good. Maybe on the margin, there's been a little bit of weakness in the low-end consumer. We've seen that in the last couple of quarters, maybe that's getting a little bit weaker in some segments. But overall, as long as people have jobs, they're going to spend. And we know the job market still remains, reasonably healthy. So, but I think you've seen this volatility in the market, even though we've seen some pretty good earnings results, primarily for two reasons. One is that rates have gone up pretty rapidly, as Leslie talked about. If we look historically, when rates move rapidly over a short period of time, it does tend to lead to equity market volatility, and that's exactly what we're seeing. And the second thing is that, look, I think we need to put the last 6 or so months in perspective. I mean, the last 6 months up until the end of March, that 6-month period that ended in March was one of the best 6-month periods in terms of equity returns if you look going back to World War II.
Right.
So it really was, we really got used to these very strong returns. And so the markets are taking a little bit of a breather with the rate move kind of the catalyst for
What about
that.
a lot of the big tech names have already reported, most of them have their earnings. How did we do there? And is that still the tide that's lifting the boats here?
Yeah, I would say, as always, it's a little bit mixed. And I would say expectations going into the reports were pretty elevated. But in terms of the numbers themselves, they were fine. And we don't have all of them in yet. We still have, Apple is coming on Thursday. I guess by the time this is broadcast, maybe we'll know those numbers already. NVIDIA is still several weeks away because they're off cycle. But yeah, in general, I mean, the big story is investment in AI infrastructure. That is still very strong. Companies have been raising capital spending budgets. Still, very solid there.
Great, thanks, David. Leslie, back with you on the fixed income side. Looking at yields. I mean, certainly it's been a wild ride on Treasuries. You look at that yield curve. The short end is just blazing ahead. 5% and higher, and then even at the long end, we're seeing 30 years looking like you get a better yield there than on a 10-year. But it's been very volatile there as well. What's going on with the fixed income marketplace right now?
Yeah, I mean, during April, we saw, a lot of, the volatility was tremendous. You were going up 15% like in a week. And a lot of this, though, had to do with the fact that the market was pricing in this potential of a hike, and they were taking out, rightfully so, some of the cuts that were there that were a little bit too aggressive. So that actually caused a lot of headwinds to those asset classes that have a higher correlation to interest rates, which would be, things that are higher quality. Those that have a little bit deeper and better credit actually did fine, right? They might have widened out a little bit, but it wasn't something that was a cause of concern, and the income that you're earning well outweighed the spread widening. But one of the things that I think is important going forward, particularly now, is that we've always said in order to get above that 501 that we saw in October 2023, you'd really have to see the potential of a hike on the table. And I do think for now, that's off the table.
That's right.
Now, when we talk about the June FOMC, we have the dot plot, right? Assuming, and who knows what's going to happen from then till now. We have, non-farm coming this week. But I really think that hiking scenario is not a big probability. We're obviously going to see them take out some of those 75 basis points of cuts they had priced in. That'll probably shrink. The market's already expecting that. So really for now, I do think that when it comes to risk assets, assuming that we don't see a continued reacceleration of inflation, right, and combined with either slowing growth, risk assets should do just fine. The volatility has been the key. I'm looking for volatility actually to start to subside a little bit, but to tell you the truth, it probably won't truly take a sidestep until they do something. This whole we have to wait for the data, we have to wait and see, is going to keep volatility going for a little bit longer, even though we do have some resolution today. That commentary could shift very quickly if we have a quarter of strong inflation.
Right. We all know that markets don't like uncertainty, neither do investors. And certainly they don't like gray areas of commentary. So yes, absolutely, Leslie. We'll all be waiting with bated breath as we see all of the next rounds of data being released over the next couple of weeks and months. So before we wrap up, I just wanted to ask you both, and Leslie, I'll stay with you since we're here. What are you talking to our clients and advisors about when it comes to best places to put your money to work within fixed income today, given what we know?
Yeah, I mean, listen, we came into the year with the expectation, with the 170 basis points of cuts and the 373 that we saw in December, that rates would rise in the first quarter. We had 4.25, we went above that. So we actually just added some interest rate risk at around that 470 10-year yield level. And the reason why we did that is because the market was coming in so bearish in terms of today's meeting, such as oh, they might hike. So we are actually extending a little bit of interest rate risk here. We're doing it in higher quality. We're still taking that yield and that carry because I don't think people appreciate, we're talking about some of these, over a decade high in income that you could earn here. And while spreads are compressed, and they are, we don't believe that spreads are going to widen that much going forward unless, listen, spreads are going to widen if inflation really gets out of control. If it's because of growth, that's fine. If it's because of inflation, then you're going to see a problem with spread widening. But I don't think that's really going to be the case. You're going to have spreads widen opportunistically, but it's not going to be a continued trend. And if anything, you should take advantage of that. But right now, we're staying in the higher quality assets, taking that income, taking that compounding income, whether it's agency MBS or corporates or, we have tips now that we think that are good quality and CMBS. All those assets, particularly after today, should start to perform well. The only, caveat that you might see in the short term, you're going to have bouts of volatility for a little while. And it's something that if anything, you add to that, but you don't, start to shift your portfolio over because it'll even out, but once the Fed takes some action.
Great, Leslie, thank you. David, same question for you on the equity side.
Yeah, sure. From a sector perspective, we have three most preferred sectors. Tech, we talked a little bit about some of the trends there, but beyond AI, you've also got a bottoming in some of the more classic sides of the tech industry in terms of PCs, servers, smartphones, and these are very cash generative, very high quality companies. We also like industrials, where we think we're seeing a bottoming in the manufacturing cycle, and industrial companies should benefit. Plus, there's secular trends going on there in terms of infrastructure and kind of reshoring and things like that. And then healthcare, which is a more defensive sector, but there are also some pockets of growth, and that ties into some of our themes that we also like. We do have a theme, a list of stocks around AI beneficiaries. We have a list of stocks around obesity and diabetes beneficiaries. We also like housing recovery plays because there still is this sort of shortage of housing out there, and so there's a supply-demand mismatch. And then the last thing I would say is, look, I would also take a look at small caps. They are very cheap. And if we're right on interest rates, as Leslie was just talking about, interest rates are probably going lower. That should be good for small caps. And I think you're going to see an improvement in small cap earnings growth as we progress over the course of the year. So catalyst to unlock some of those low valuations for small caps.
Excellent, great, lots to unpack there. So thank you both for joining me for this quick rundown. There's a lot to get through in a short amount of time. So I appreciate you both doing that, Dave Lefkowitz and Leslie Falconio. Good to see you both. And thank you all for joining us. Make sure you're checking out our website for more content from the Chief Investment Office at ubs.com/views. Plus, you can follow us on social media. We're on all the major platforms, including Instagram. Check out @UBS Trending. Follow us there. Find lots of content from here in the studio that you're not going to find anywhere else. And as always, if you have questions about your portfolio or anything we spoke about today, make sure you're talking to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.